Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Thursday, March 15th, and we got a lot of economic news releases scheduled for today. Not much on the headline news, and so we'll just jump right on into it. We'll start off with the weekly jobless claims. Last week, they reported 365,000 people applying for unemployment. We figured we'll take a step back a little bit, down maybe 355 reported this week, and actually dropped a little bit further down to 351. So a little bit better on the claim side. So less people, especially less than they forecasted, applying for unemployment. The next item is a producer price index. This is also known as the PPI, or basically this is the index to gauge inflation on the wholesale level. And this is for February's numbers. So January we had a 0.1% increase in inflation numbers. I figured it would jump up to 0.5, and it jumped up to 0.4%. So this is when you factor, food, energy, and stuff in here, so it could create a lot more volatility. But when you exclude it, get the core PPI, we had a 0.4 for January, and we figured forecast about 0.2, and we came in at forecast. So when you strip out the energy, which creates the volatility, it came in at 0.2%, and this is kind of where the Fed watches because of the volatility that energy can create in this. So the next item here is manufacturing in the New York region. This is the Empire State Index for March numbers. We had 19.5 for February. You figure it was going to pull back a little bit, contract a little bit in March, but actually it went up a little bit. So we had a decent reading for manufacturing in New York region, and then manufacturing in the Philadelphia region is underneath the Philly Fed Index. It was at 10.2. We figured it would go up to about 12, and it went up to 12.5. So we had a decent reading on these on the surface here, but some investors, when they look at the underlying numbers, that new orders are down. So there's some mixed reviews on this as to what this will really mean. So they'll continue watching this probably next month to see where things are at, as mentioned that the new orders are down. So we'll just kind of jump over to the headline news here, and basically a piece of news we really have is the stock market's up slightly. Most of them are pretty light trading. Yesterday was kind of a big day in the stock market, so today they're kind of taking a breather, it looks like. So we'll take a look at see how the bond market is playing out today, and where interest rates are moving. As you can see by the big red candlestick, we had a big drop yesterday. We lost probably about from where we left off on Tuesday, we had about 79 basis point drop. So over this week, we probably had well over 100, 150 percent drop, basis point drop. So that means a pretty good chunk in terms of interest rates that we jumped up quite a bit. Today we're about where we left off. We started the day off about almost 30 basis points lower, about 25 basis points lower. We start off the 102, so we're right now up about 25 basis points. So we're kind of just touching where we finished off yesterday. So rates are about the same where we left off yesterday. So. And you know what, to be frank with you folks, we're probably going to we may have a spike up there just to close some of those gaps as we talked about, like some of these gaps here, but we probably won't be short. It'll be pretty short-lived if we do. We have more space to drop. There's a couple reasons for this. One being that the Fed kind of stopped their purchases of the mortgage-backed securities, a large quantity from the quantitative easing 2, or quantitative easing. So they kind of stopped that larger push. There's talk that there's rumors that maybe they did, but they're probably going most likely meeting to meeting. There's no mention of them continuing that in this last meeting this week. Also, with the stress test that came out, there's some speculation that now a lot of these banks have passed that they're talking about giving dividends to their people, and so there's going to be less demand for a lot of mortgage-backed securities right now, and China's probably not going to pick up the slack. So because it was artificially purchased and creating these lower interest rates, we probably already seen the last of those great rates. Not to say today's rates aren't bad or great, they're still very good, but we probably won't see those rates for some time now. So just to give you a heads up on that. All right, folks. But today's, again, I'm not gonna paint a bad picture because if you go back to '80s, talk to anyone who owned homes in the '80s, they're double digits, and so these are phenomenal compared to what it was then. So people got kind of spoiled in this day and age with where the interest rates have been for these last couple of years. So. All right, folks, you guys have a wonderful day. Hopefully, catch you guys tomorrow. And if you guys are on Mike's Daily Market Report, please subscribe, get your free daily updates emailed to you. Have a wonderful day.